Good afternoon, and thank you for joining us for today's web seminar. I'm Karen Weisskopf, the Director of Marketing at First Long Island Investors, and I'm joined today by Robert Rosenthal, our Chairman, CEO, and Chief Investment Officer, Ralph Palleschi, our President and Chief Operating Officer, and Philip Malakoff, Senior Vice President, Wealth Management, and a member of our Investment Committee. Before we begin, I'd like to take care of a few quick logistical things. First, all participants are in listen-only mode. Second, after the team delivers a presentation, we'll have time for questions and answers. You can send questions at any time through the question box on your screen. Right now, you should see a slide that says today's speakers. If you're not, please type something into the chat window and we'll try to help. And finally, our General Counsel has asked that I remind you that today's session may discuss the performance of some strategies and that past performance is not a guarantee of future results. I now hand it over to Bob.
Thank you, Karen. And first, for those of our listeners who are in the Northeast, please be prepared for a snowstorm and travel safely if you're traveling. The slide shows a great quote from John F. Kennedy. Change is the law of life, and those who look only to the past or present are certain to miss the future. And given what we're going to discuss, we expect there could be some significant changes for the future. Our agenda today is chock full. A big change is coming with a big maybe, 2017 expectations, our approach to 2017 and beyond, and then we'll have a period of time for questions and answers. Our first slide suggests, and we know it from the surprise election last year, there's a new sheriff in town. And given the change in the election, with the Senate remaining Republican, the House remaining Republican, and a Republican president elected, we took a look back in history to see how equity markets performed during different political scenarios. And let me say at the very beginning, history is a guide, not a guarantee. As you can see on this chart, this graph on the extreme left, where there is a Republican Congress, both House and Senate, and a Republican Congress, the stock market has performed exceedingly well, averaging about 15% per annum. And we've looked back to 1933 through the present, with just a small exception of a few years. So it's quite obvious that stock market exuberance has taken place during a period of time when the House, the Senate, and the White House was occupied by Republicans. And that's the case that we have today. So as you can see, this would suggest a strong stock market. But again, it's history, it's a guide, it's not a guarantee. Our next page shows that the initial stock market reaction post the election in November has been quite positive. Stocks acted very well to a Trump and Republican victory. Of great significance also is consumer confidence. And the two charts that we have on the bottom of the page show exactly what happens in 2016 from November to the end of the year with a spike in consumer confidence, and then how this consumer confidence compares to periods of time in the past. And as you can see from the what we call decession, somewhere between recession and depression of 2008 and beginning of 2009, consumer confidence has improved dramatically, and that continues. So the initial reaction to a change from the prior administration to this new administration, where all three branches are controlled by Republicans, thus far has been positive. Now, why is that the case? Campaign promises seem to have caused significant optimism. So let's start with each one of them and suggest what it may portend for the future. Major corporate tax reform was something that was considered significantly during the campaign. Corporate tax reform, or lowering corporate tax rates in this country, should make the U.S. more competitive globally. It should lead to productivity gains and economic expansion at a faster pace than the 8 Obama years. Lower taxes means more cash flow for investment and productivity. If you look to the chart on the left, it shows corporate tax rates, which includes some local taxation at the state level. and it shows that the United States has averaged approximately 40%, and the companies or countries that we compete with, France, Japan, Germany, Canada, China, Sweden, United Kingdom, have much lower tax rates. So this is a competitive disadvantage for U.S. companies. And actually, it's even worse than this. If you consider the fact that many U.S. smaller businesses operate as LLCs or subchapter S corporations, their effective tax rate at the federal level is actually 39.6%, plus the local taxes, therefore exceeding 40%. So some reform is required to try and reduce the tax burden for U.S. companies such that they will be more competitive with foreign countries. If we turn the page, we'll see some other campaign promises that are causing some optimism. Individual tax reform, simplify the tax code, and reduce tax rates to deliver some economic benefit to the middle class. As we all have read, there's a great gap in equity or in wealth between the middle class and the upper class and the lower class. The middle class has struggled with stagnant wage growth over many years, and yet there have been some increased expenses to them. So they've been under the gun. Trump campaigned to reduce individual taxes, particularly for the middle class. At the same time, to try and keep it fiscally responsible, there have been suggestions about eliminating certain loopholes for the well-to-do. One that's been discussed a lot is eliminating the carried interest. Individual tax reform, in our opinion, would be very helpful to the economy, especially given the fact that 70% of the economy is driven by the consumer. Another campaign promise, which, by the way, has bipartisan support, and that is investment in the country's infrastructure. Support investment in transportation, clean water, a modern and reliable electricity grid, telecommunications, security infrastructure, etc., would be very helpful. And as we travel around the world, one sees that our infrastructure has been left behind. This would be very helpful to business, very helpful to consumers. One way to pay for it is a possible repatriation of foreign monies owned by U.S. companies to the U.S. with a tax, and that tax would go 100% for infrastructure, thereby contributing to infrastructure rebuilding, but not at the expense of the U.S. Treasury. Again, this has gathered some bipartisan support, but we'll wait to see whether or not it becomes enacted. Also, a reduction in the number and scope of business-related regulations. Almost 3,000 new regulations were created in the last 8 years. Should reverse conditions that have stifled business growth and in turn lead to better paying jobs. Many small businesses, and the financial community in particular, have complained about significant new regulations that have held back capital creation, investment in small businesses. So reducing the number of regulations will stimulate growth from a more confident private sector, in our opinion, and that's reflected in both business and consumer or individual optimism. Another campaign promise causing optimism was the Republicans' desire to modify or repeal the Affordable Care Act. They intend to create greater efficiency, larger pools of healthy participants, increased competition, and the reduction of Medicare/Medicaid fraud. At the same time, they have also promised to maintain the provision of insurance for more Americans and for those with pre-existing conditions, including keeping younger people up to the age of 26 on their parents' insurance policies. I'm sure we can all agree that having catastrophic insurance is essential to almost all Americans, if not all Americans. However, the cost of this in the past several years has been significant. Higher deductibles have been criticized, and the inability to keep your doctors has also been criticized. So we're hopeful that some modification or repeal of the Affordable Care Act will take place in the near future and improve upon that which has already been done. Border control was also a campaign promise. It's obvious from all of the TV things that we've seen that a great number of illegal immigrants have crossed the southern border in the United States in particular. So that to stem the illegal tide, rid the country of violent illegals, and stem the tide of illegal drugs that have plagued many of our communities is essential. create a better system for peaceful, constructive illegals to remain, but not with guaranteed citizenship, seems to be the right prescription for our border problems in our immigration system. Another campaign promise, which is hard to explain given the paralysis that has taken place in Washington, is the proper use of Congress in a bipartisan way. Provide for constructive legislation so that the overuse of executive actions no longer is needed. This is a tough one, and we'll wait to see whether or not that becomes a reality, but it certainly hasn't been the case the last 8 years and the very beginning of this new administration. We turn to what our expectations are for 2017. They're pretty simple. If tax and regulatory reform take place, GDP expansion will be more robust. You'll see a slide later in this webinar that shows that expansion during the last 8 years of the prior administration averaged about 2%, well below that which is expected in a recovery after a severe recession. So we're looking forward to what we hope will be GDP growth of at least 3%. That would be great for the country and great for all Americans. Corporate earnings should show steady improvement. A reduction in corporate tax rates will help that. A stronger economy or GDP expansion will help corporate earnings. That bodes well for the equity markets. Households continue to delever their balance sheets. We'll show you later on in the presentation that much progress has been made at the household level in delevering and controlling the level of debt. Ongoing strengthening of the labor market is essential. Even though our unemployment rate has ticked down to 4.8%, there are still a lot of folks that are not employed that perhaps would want to be employed. So we believe there will be a continuation of the strengthening of the labor market. Of great note is our banking sector. It's the strongest it's been in 5 decades. We'll talk more about that in a little while, but that is critical to having a strong economy, investing in the economy in the future, and not falling back the way we did in 2008 in a financial crisis. The housing market is critical to the U.S. economy. It's in balance, it's very affordable, and we're building more homes based on the desire that's out there for people to have first-time homes and move up. Oil prices should continue to stabilize. So instead of going from 100 a barrel to 25 a barrel, back up to 60 a barrel, we believe there's a range that we'll be in which is comfortable for consumers and business. Now, one caveat, a lot of these expectations are based on regulatory reform, tax reform, and cooperation in Washington so that the country can move forward. However, some of these reforms could take longer than expected, and we have to watch very closely, and that's why we're cautious. And now it's my pleasure to turn the presentation over to my partner, Phil Malakoff.
Thank you, Bob, and welcome to our clients and friends participating in the webinar. We believe that GDP growth will be robust. Recently, we have seen signs that the economy is accelerating. Third quarter real GDP at 3.5% was the fastest gain since 2014. And in fact, nominal GDP growth, which includes inflationary forces, grew at 4.5% during the second half of 2016. Bob just talked about a lot of the new administration's plans for regulatory and tax reform, repatriation of overseas assets, and fiscal initiatives such as infrastructure spending. And we expect real GDP to continue to expand under these proposals. Earlier, Bob discussed consumer confidence. Both consumer and business confidence measures are well correlated with GDP growth, and both are near post-financial crisis highs. The CEO of the National Federation of Independent Businesses recently said, "Small business is ready for a breakout," and that can only mean very good things for the U.S. economy. Business owners are feeling better about taking risks and making investment, and it's really small businesses that drive the economy. First Long Island Investors expects 3% GDP growth in 2017, about average growth over the last 50 years, as you can see on the chart, but higher than the current recovery's 2.1%. And we wouldn't be surprised if it was closer to 3.5%. Accompanying a strong and expanding economy, we expect corporate earnings to show steady improvement. Now you can see on this chart that following many years of growth following the financial crisis, that beginning in late 2014 and continuing throughout 2015, quarterly earnings growth declined due to slowdowns in the energy and banking sectors. Beginning in the third quarter of 2016, they rose and actually accelerated at the fastest rate since 2012. Estimates are for $28.87 in the fourth quarter of 2016. And with most companies having reported at this point, we expect that to be a fairly accurate estimate. And we expect fourth quarter earnings to grow to over $32 this year and over $35 in 2018. So we continue to expect improvement in corporate earnings going forward, which will help equity markets appreciate. Since the financial crisis, consumers have been delevering by paying down personal debt so that they are near the lowest levels in decades. Debt service as a percent of income is near 10%, down from over 13% pre-crisis. All forms of debt have been reduced, including mortgage, credit card, and auto loans. With lower debt levels, households' net worths have climbed and now stand significantly above pre-financial crisis levels, with household net worth topping $90 trillion. One of the reasons for this is the strength of the labor markets. Employment levels are nearing the natural rate of employment as the unemployment rate has fallen below 5%, and that's down from 10% in the fall of 2009, as you can see in the chart on the left with the dark blue line. Labor markets are tightening up, and we're hearing from many of our portfolio companies that they are having trouble finding qualified employees. Over 4.5 million jobs have been created in the financial services, information technology, and business service areas since February 2010. In fact, civilian employment for those 16 or older is at an all-time high in absolute numbers, with almost 155 million employed. However, the labor force participation rate, which is shown in the small chart in the upper right, shows that fewer Americans on a percentage basis are employed or looking for work. This may be due to extended entitlement programs available under the Obama administration. But interestingly, in the January employment report, which was released just last Friday, the participation rate moved higher, as well as the unemployment rate ticking higher, meaning that many Americans have re-entered the workforce and want to find employment. We believe this is a positive development. The banking sector is the strongest it has been in 50 years. Capital ratios are as high as they've ever been. And we can see in the chart that capital, as a percent of risk assets on banks' balance sheets, are significantly higher since the financial crisis. Banks have been more selective in making loans, so there have been fewer bad loans and defaults. However, the downside to this is that there's been less capital to lend, so the economy has been held back. The new administration would like less regulation in general, which would lead to more lending and a more vibrant economy. The housing market has been improving, and 2016 was the best year for the housing market since the financial crisis. Now, this is a very busy slide. It's packed with a lot of information, so give me a moment to explain it all. But what we can see, starting in the chart on the upper left, is that both existing single-family home sales, which is the blue vertical bar lines, as well as new single-family home sales, which is the red line, have been rising since the recession. So why is this happening? Well, mortgage rates remain low on a historic basis, as seen in the green line in the chart on the bottom left. And we already discussed that mortgage debt service has improved as consumers pay down all forms of debt, as seen in the chart in the upper right. And this allows home buyers more flexibility in purchasing new homes. As well, there is optimism amongst home builders. The chart in the lower right measures home builder sentiment, which has improved significantly from low levels in early 2011 to now. So last year, we saw the best home sales levels in a decade, and this was in spite of historically low supply levels. We believe this bodes well for the economy. The next chart is on volatility, and this should look very familiar to those of you who have participated in previous webinars. So volatility, as measured by the number of days with an S&P 500 range of greater than 1%, was lower in 2016 than 2015. It was 87 days in 2016, or 119 days of volatility in 2015. But we expect that given the potential for surprising populist election results, think about last year's Brexit and Trump victory, unexpected executive branch actions, and unfortunately terrorist acts, that volatility will reemerge in 2017. Interestingly, January was a very quiet month with no quote-unquote volatile days. We don't think this will last, and as we will discuss, we believe that clients should be allocated defensively. When volatility does return, it will create opportunities to commit capital and rebalance allocations. So the next slide we haven't shown before, and it's a very interesting map that shows which countries have the potential for economic, political, and terrorism risks. Those with the least risk are in dark green. Neutral Switzerland, by the way, is rated the least risky in the globe, followed by light green, light orange, dark orange, and those with the most risk are in red. You can see that the highest risk countries are primarily in Africa, parts of the Middle East, and some of the former Soviet Republic states, and others such as Venezuela and North Korea. The U.S. and many of our economically developed allies are light green, signifying low risk, but as we have experienced, no matter the risk level, all countries are potential targets of terrorism, and that is not beneficial for stable equity and bond markets. So, turning back to the economy, we believe a recession is not imminent. And in spite of being 90 months into an economic expansion, albeit one that has seen rather low growth and been rather sluggish, we believe that there is room for the economy to run and accelerate in 2017. And we can see on the chart that expansions have lasted much longer than the current one. So how can we say with so much certainty that a recession isn't imminent? One of the things that we focus on is the shape of the yield curve. When the yield curve becomes inverted, meaning that shorter dated maturities yield more than longer dated maturities, and we tend to compare the 2-year versus the 10-year, that there is a higher degree of certainty, or there is a high degree, not higher, but high degree of certainty that there will be a recession in about 12 months. If we look at the yield curve chart on the bottom of the page, we can see that the yield curve has actually steepened in the last 6 months. The current yield curve is in blue, it's the top line, and has higher interest rates and a steeper slope than the curve 6 months ago, which is in green. There's actually less chance of a recession today than there was on June 30th. We will continue to watch this, but we don't believe an inversion will occur anytime soon. We are also monitoring household and corporate debt levels, which would contribute to the end of an expansion. But as we've seen in earlier slides, these statistics are trending towards economic growth, not a slowdown. From a valuation perspective, PEs are ever so slightly above average, trading at 17.1 times next 12 months estimates. When the CPI, Consumer Price Index, is in the 0 to 2% range, which is the second blue bar from the left, as it is currently, at 1.8%, the average PE has been 15.9 times over the last 66 years. However, the new administration's stated tax policies, which include a lower corporate tax rate, would reduce those PEs, all other things being equal, as companies will see more income drop to the bottom line with a lower tax rate, providing them with higher earnings per share. We are viewing inflation differently in 2017. We don't view it as a threat, not yet, but it is starting to trend towards a more historically average rate. And we view this as a positive, as it means the economy is improving. I'd like to introduce our president, Ralph Palleschi, who will review our approach to 2017 and beyond.
Thank you, Phil. As you've heard from Bob, first of all, I apologize. I have a cold, so if you hear me coughing, that's not me. It's the cold. We have, based on what you heard from Bob and Phil, our approach to 2017 and beyond is basically consistent how we've talked the last couple of years in maintaining a diversified portfolio with a prudent asset allocation. You can see from the chart how we think in terms of, there are basically 4 silos that we look at: security, defensive strategies, traditional equities, and private investments. Currently, we're modestly underweighting fixed income simply because of the interest rate environment today. We don't think there are many good situations in the bond market right now. We are overweighting defensive strategies. The market has had a very good run for the last 6-7 years, so we think being a little more defensive makes a lot of sense. We're modestly underweighting the traditional equities, and we'll show you the effect of that when interest rates get a little higher later on in the presentation. And the last silo is private investments, and we utilize that as appropriate. It's not appropriate for a lot of our clients, but some of our clients, we have some pretty good situations for that. The next slide is really why we're underweight fixed income. You can see currently the federal funds rate is about 63 basis points, and the Fed has a target of about 3%, which is at the end of 2019. That's the purple number there. And the Fed estimates are for currently about an increase of 75 basis points per year for the next 3 years, which would get them from 63 basis points up to 288 basis points. The market, however, isn't on that same trajectory. The market is only up to about 169 at the end of 3 years. So therein lies the problem. If the Trump administration is moderately successful, and we do have a lot more growth than we think, or we have higher inflation, it may cause the Fed to raise rates a little faster, and the market will have to adjust to that. Our current approach on the next slide is basically to overweight the defensive basket. And the defensive strategies are designed to do 3 things: to mitigate the volatility, to minimize the downside capture, and to capture a significant portion of the market appreciation. And you can see the examples that we have listed here, whether it's hedge growth, dividend growth, or multi-strat. Those are the strategies under the defensive bucket. I'll let Bob cover the next slide, and then I'll take it back.
Thanks, Ralph. As Ralph pointed out, we're overweighting our defensive basket. And in our defensive basket is our dividend growth strategy. And I just want to reiterate our investment objectives, as you can see on the page. Provide a total return over the long term of 8% to 10%, derived from an approximate 3% current dividend yield, plus anticipated annual increases of those dividends, supported by underlying earnings growth and free cash flow of the portfolio companies. And second, and very important, minimize downside capture while maintaining significant upside capture, which basically means in a robust market, we'll do well, but not quite as well as the market. But in a down market, we should do better than the market because this is a defensive strategy. And the strategy is based on an academic named Myron Gordon, who created the Gordon growth model. And it forecasted performance. If you look at the chart on the lower left, you'll see that performance correlates to, not perfectly, but correlates to a dividend yield plus the dividend growth rate. And we've taken a look at 5 years of performance for our dividend growth strategy. And during that period of time, our average dividend yield was about 3.2%. And our dividend growth rate was about 8.3%, which translates to something in excess or about 11.5%. Our actual return during that period of time on a gross basis was 12.1%, and we charge a 1% fee going down depending on the size of the client's assets. and you subtract that 1%, and you get to this performance of about 11.5%. If you look over to the right, you'll see some key statistics. Last year, we achieved about a 12.7% net return after fees and expenses. Over the 3 years, 6.2%. Over the 5 years, 11%. And since the inception of the strategy, 11.4%. Our current dividend yield is approximately 2.9%. Of note, the dividend increases last year for our portfolio were 8.9%. And again, a key tenet of this strategy is to have dividend growth well above the inflation rate. So by starting with an almost 3% yield, which is well above treasuries at this point, well above the S&P dividend rate, and then having an 8.9%, or we project between 7 and 10% dividend growth, we're keeping the growth in income to our clients well above inflation and well above alternative investments. And of great significance is the fact that the average company in the portfolio has not just paid a dividend each year, but it has raised a dividend for 23 consecutive years. So that tells us something about the culture of the companies in our portfolio. And then, of course, it's up to us to make sure that the companies are financially stable enough to pay that dividend, increase the dividend on an annual basis, but not rob those companies of the ability to reinvest in their companies such that that earnings growth can continue for years to come. So this is a very defensive strategy. You can see some of the names in the portfolio. They're quite well known. They are financially strong. They're still growing, and they represent management that reflects a culture of giving back to shareholders in the form of cash dividends. So this is an example of a strategy that we're very comfortable with in this uncertain environment. It's a core strategy for our clients, and we believe that every client should be invested in our dividend growth strategy. And I'll turn it back to Ralph now.
What we did is we looked at a 20-year, going back 20 years in terms of defensive and traditional equities and how did they perform versus cash. And if you look at the chart, the yellow line is a 90-day U.S. Treasury bill, and you can see that that grew from $1 million to $1.5 million. The CDs have gone a little higher than that to $1.666 million. But if you look at the green line and the blue line, the green line is the S&P 500, and the blue line is the S&P Dividend Aristocrats. The Dividend Aristocrats are companies that have grown their dividends consecutively for at least 25 years. So you can see that the dividend strategy that Bob talked about a couple of seconds ago made a lot of sense over the last couple of years. And the market went through different phases. I mean, in the 2000s, the market was kind of flat. But if you look at what happened from 2008 till now, it's been a pretty good ride. One of the questions that has been asked, and how does the market do when you're in a period of rising interest rates? And you can see from this chart that the market still performs reasonably well even when interest rates are rising. You can go back to different periods of time, and in those squares, that is the S&P 500 annualized return in those periods. And obviously, if your interest rates are 7, 8, 9%, you're going to have a little less performance than they would be if they're 2 or 3%. But in any of those periods, you can see that in a period of rising interest rates, the market still did reasonably well. And Bob, why don't you summarize where we are?
Sure. Well, thank you for listening. We've thrown a lot of information at you, so I'd like to try and summarize in the last few minutes before we take questions. 2017 began with optimism, which is reflected in the equity markets. As the new administration begins to implement some of its campaign promises, we will see change, and it will impact us as investors. However, as we pointed out, it could take longer than expected, and if it does, which we believe it will, greater volatility will return to the markets. We've got to be careful and cautious. Growth in corporate earnings and GDP is encouraging, as Phil pointed out. We expect to see GDP growth by at least 3% if some of these actions taken by the new administration are implemented in Washington. As stated, volatility is likely to return, and we need to be ready for it. And that's why we have a defensive tilt to what we're doing. Valuations in general are not cheap. So careful stock selection with growing earnings, quality balance sheets, and reasonable valuations are incredibly important, and that's what we look at very carefully. Fundamentals are always key. Current yields on bonds and cash appear to be unattractive. And as Ralph demonstrated, keeping too much money in cash over long periods of time rob you of the opportunity to grow your net worth. Long-term investors should remain in the equity markets, focused on investments in solid companies with reasonable valuations. And we give our clients several ways to do that, and particularly in a defensive way. We remain committed to selective opportunities in real estate and private equity to give our clients the proper diversification from the standpoint of how they invest their liquid net worths. Prudent asset allocation with an overweight to defensive strategies is the best course for virtually all investors. Again, the key to compounding is to not have significant down years. And through a prudent asset allocation, we seek to avoid that even when the markets turn down. So we hope you have found this to be helpful, and we'll now ask for questions.
Thank you so much, Bob, Ralph, and Phil. We'll now take questions, and we've gotten a few. We'll take as many as we can get through, but we'll start with this. So the first question we got, and you guys can tell me who wants to take it. We also have a few other members of the investment committee in the room if we need their expertise as we go through this. So we talked about how corporate earnings have begun to improve and have reversed course following a period of weakness. Going forward, what catalysts do we need to continue to materialize to maintain this positive momentum?
I'll take a shot at that. It's Bob. Corporate earnings reflect business confidence to a great extent. It also reflects the ability to get capital. And as we've mentioned before, banks have significant capital that hopefully they'll be able to lend a bit more generously with a lesser regulatory environment. And also, if companies can bring back monies from overseas through repatriation, there'll be more money to invest. Investment tends to help R&D, it helps productivity, it leads to higher corporate earnings. That plus the potential for reduced corporate tax rates is a great prescription or combination of things to help S&P earnings or corporate earnings in general continue to grow. When that all happens and earnings grow, as Phil pointed out, this upturn has already started. As it continues, it makes valuations for the companies we invest in more attractive, and that should lead to appreciation for our clients' portfolios.
Great. I think you actually answered two of our questions all in one, which is excellent. So thank you for that. Okay. One of our clients asked, in the letter we recently sent, we mentioned that value stocks outperformed growth in 2016, and they're curious if we think that will continue in 2017.
All right, I'll take that. That's a tough one. The reason for our prudent investment allocation model is that we don't have a crystal ball that tells us when growth is going to outperform, if value comes back, or international investing becomes appropriate. The reasons for value outperforming growth last year was the great expectations of repatriation, industrial re-emergence, the fact that the banks will make more money because of a steeper yield curve, and the fact that regulations will be relieved to the banks so that more lending will take place. So there was a great push into financial companies, a great push into industrial companies, and energy. There was an OPEC deal with curbing production, which also gave a lift to the energy markets. All of these are considered value areas, and they've done well. The uncertainty is if the new administration does not enact its corporate tax reform, it does not enact repatriation, it does not enact a rebuilding of our infrastructure soon enough, there may be some disappointment by investors, which will result in those areas falling back. And then the great growth companies that are very steady with solid, consistent growth, who were shunned last year, may come back. A matter of fact, the first, 6 weeks of this year, growth is actually outperforming value. So again, we try and have a diverse allocation for our clients where they have exposure to both growth and value, and that's incredibly important.
Great. We have another question that you showed a slide that indicated we've had a significant number of months of an expansion and that we don't expect a recession in 2017. What is your current best estimate as to how far away that is?
I'll take that. If you notice the mindset of the Federal Reserve right now, the Federal Open Market Committee, they're pretty conservative, and they're moving very slowly. I think their current mindset is to sit back and wait to see what the new administration will put through in terms of policies and regulations. And so that's why they're only anticipating 3 rate increases this year. The market actually thinks there'll be less than 3 rate increases. As Phil mentioned in his presentation, if we get an inverted yield curve, you can almost bet that a recession will take place a year after that. I don't see that happening probably until 2019. You all know that I'm on the board of a bank here in New York, and our outside economic consultant is telling us basically he sees very slow increases in the Fed. You will see probably somewhere between 75 to 150 basis points over the next 2 years, and recession probably sometime in 2019. So that's the current estimate. That can change drastically if what Bob mentioned before happens in terms of what the new administration is going to do, and the Fed starts to raise rates quicker. But right now, it looks like we're at least a couple of years away from that.
Great. Well, that wraps up our Q&A session. On behalf of the entire team here at FLI, I'd like to thank everyone for joining us. I hope you've all found this session interesting. For our clients on the line, I just want to remind you that our investment committee is always here to discuss your individual asset allocation, and the start of a new year is always a good time to look encompassing at your wealth management. Please just give us a call. Hope everybody has a great afternoon, and again, for those in the Northeast, that tomorrow's a safe day.